Welcome to Founder Files, the podcast for growth-minded leaders, investors, and operators shaping the future of business. Each episode dives into the critical decisions behind scaling, from finance and fundraising to leadership, strategy, and technology. Founder Files is powered by Cypher, the AI-powered and human-led finance partner helping growing companies scale with clarity and confidence. Learn more at cypherfin.com. All right, founders, CEOs, it's the end of the year. We're going into a new year. You're probably feeling extremely overwhelmed trying to prepare for a brand new year. Your investors are probably pressuring you for your financial reports. You are maybe going to raise capital from a VC in Q1 2026. But oops, your financials are not up to date and you do not know where to start. It's complete chaos. It's a mess. You didn't plan for it ahead of time and now you have to catch up. So today we're digging into reasons why many founders struggle with their financials and the real starting point of financial clarity. Not talking about anything sexy, not software, not dashboards, not a shiny forecasting model. We're starting with one thing: cleaning up your financials so you can build everything else on a clear and solid foundation. Many founders leave clean financials as the last priority until it is the first. Till ding, 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 investors are raising the red flag and asking you for US GAAP financial reports. So I think the biggest reason is simple. There's no true ownership. You just do not feel like you have the responsibility of having clean financials. It's not your priority. But let me tell you, the best CEOs and founders I've worked with are the ones who stay close to their numbers. They ask so many questions. They know how to read their financials and they treat finance as a strategic muscle. I've had founders who literally knew nothing about accounting, not even what a balance sheet or P&L is, and then turned out to know so much accounting that sometimes I just think they're accountants. I mean, they ask really accurate technical questions, which baffles me. But I find that super inspiring. Honestly, even if you outsource your accounting and finance function, you should understand the process. You should know exactly what your finance team is doing before you trust it. You're also probably pushing finance to the bottom of the list because of cost. You're assuming it isn't a driver of growth, so why invest in it? But in reality, it is one of the core growth engines of a healthy company. It's your scorecard. Imagine a game without a score. I mean, would that game make any sense? What's a business without numbers? Clean financials let you make sharper decisions, present investor-ready reporting, model cash confidently, know your runway, your burn, and pressure test your ideas to ensure they're actually worth pursuing. If you're sitting in chaos right now, numbers don't make sense, margins are blurry, cash feels tight, even though maybe your revenue is solid, this is the episode you listen to all the way through. Once you clean up the past and fix the structure, everything else becomes easier. Reporting, decisions, fundraising, even your sleep becomes so much better. So let's get into it. Clean up the historical financials. That is a non-negotiable first step. Founders tell me all the time, I mean, come on, let's forget about the past. Let's start fresh. Let's start from today. But that's not possible. Guess why? Your numbers roll forward every year. If your beginning balances aren't accurate, nothing after that is accurate. Your financials roll forward. Your bad cash balances will roll forward. Your wrong credit card balances will roll forward. Your sloppy receivables will show. All of that snowballs into the current year. The balance sheet is a point-in-time financial statement. It's like a snapshot of your business that includes previous balances. So it summarizes your company's assets, liabilities, and equity. That's probably something you already know, but it does accumulate. So it does show your previous balances as well. And oftentimes we ask you for comparative balance sheets. So you'll probably have to present your current year balance sheet with the previous one. So the previous one has to be accurate in order to compare apples to apples. Can't compare apples to oranges and present that to investors. That's just a no. And you just can't build clarity on a crooked foundation. So step one is simple. Clean up the historical books. You need to reconcile every single account. So your balance sheet statements, every single line item on that balance sheet needs to reconcile to a schedule. It needs to reconcile to a statement. Reconciliations could sometimes be tricky. We're talking here about US GAAP reporting. We're not talking about cash basis accounting. You need to have either you're an accountant and understand reconciliations, or you need to have experts handle that to to give you proper reporting. Once you have that done and everything is clean, you've reconciled everything, then you can start thinking about rebuilding a new chart of accounts so it matches how your business actually works. Note this, SaaS business would not have the same chart of accounts as a video production business, for example. There are different types of revenue streams that you could have. It's a different cost structure. For example, SaaS companies will have subscriptions revenue. The video production company would have long-term contracts, so it's a different type of revenue recognition, which I'll talk about in a few seconds. Your cost structure may be different. SaaS companies will have hosting fees, for instance, will have customer support. All of these go into COGS, so you need to know that. Versus a video production company will have probably rental of equipment. It will have a rental of a location. It could have just different things that aligns more with their business model. Some companies will have inventory. If you don't have inventory, do not put it on your financial statements. Sometimes I see financial statements of a company that would never have inventory and their balance sheet will say inventory and put 0 next to it, which drives me insane. You don't need to have an inventory account on your financials if you don't have inventory. So, talking about chart of accounts and US GAAP reporting, one of the main things that you need to know in order to get back on track is your revenue recognition. It's really important to recognize your revenue properly. This is ASC 606. You need to know the guidance and you need to apply it properly based on your business model and industry and your business processes. You also need to know what goes into your COGS. This is all really important to understand your margins. Your margins are a really good indicator of your business performance. It's also really important to have them accurate in order to build proper projections and for your CFO to know how to do your financial modeling, set up the right KPIs, and help you drive better business decisions. So all of this is to say, when the structure is wrong, your numbers are wrong. So having a good chart of accounts, I think, is really important as a first step into cleaning up everything. Yeah, maybe one example that I noted here and wanted to add is e-commerce founders. There's so many different accounts that are not similar to other companies. For example, like your product costs, your packaging, your shipping, your ads, and fulfillment. These are all accounts that are really good to drive your KPIs. If they're not properly set up on your chart of accounts, are not properly mapped, it's going to be really hard understanding your product profitability and calculating the right KPIs, also understanding your margins, etc., etc. So it's chart of accounts, revenue recognition, COGS, margins, really important to set in place so that you can have proper financial reporting. Once this is done, everything starts making sense. So we did clean up the books. We have our chart of accounts. We know how to recognize our revenue, how to categorize our COGS, etc., etc. We now need to streamline our processes. We need to centralize systems, stop the daily chaos. A clean foundation means nothing if your daily operations keep creating messes. So the next layer is tightening up your processes. This mitigates the risk of errors. It mitigates the risk of fraud. It gives you back hours of your life. Trust me, you will save so much time and money if you have the right processes in place. First off, maybe let's talk about AP. I'm talking that you pass early stages and now you have a list of vendors that you're paying on a monthly basis. AP must have structure. Listen, there's so many really, really good tools out there that we also use. So note them, please. Ramp is a really good AP tool. Routable, Bill.com. These are top 3 that we really, really like at Cypher. You can use these to streamline your AP workflows. In addition to having the right tool, you also need to have a complete vendor list with all of their information, a good vendor master data. I can share with you what a vendor master file should look like, what ours at Cypher looks like. That way you can replicate that. For example, at Cypher, even though we use automation, we still need to properly document everything, and we like to have everything, the vendors list and the customers list, really accurate. Not everyone should have access to this list because it could include really sensitive information about your vendors, but you need to have a vendor master data list that includes all of your vendors. You could also include what their GL code would usually be, so you can automate some of the expense accounts through Ramp, Bill.com, or Routable, or even on QuickBooks or Xero. You can note what the currency is. It's also really important to know whether they want to be paid by card or by payment type. Set up approval workflows, know who's going to approve payments, AP payments. You cannot have just one person taking that back. It's really good to set up approval workflows so that one person can set up the payment and then another person approves it. Usually CEOs that we work with like to approve the vendor payments themselves, or we have a manager that does that for them and handles their cash flow management if that is something that we're handling for them. You also need to track what vendors are 1099 vendors and collected their W-9s. This is going to be so helpful at year end. It's going to save you so much money when you flagged and identified who all of your 1099 vendors are. That way at year end, when you're filing for your 1099s, it's going to be a click of a button, especially if you've automated it through the AP platforms or through your payroll platform. So if you want to have this list, just click on the link in our description and you should be able to download it and fill it out with all of your vendors' data and set up the right AP tools, and you should have a more streamlined AP workflows. And again, that it will save you so much time. I mean, we've had situations where our CEOs that we've worked with that came to us after like double paying their vendors or sending checks to their vendors, and it was creating so much chaos. I just could not keep track of it anymore. It was just so much time and effort that was put into it when it could be a workflow that's really simple and that you can delegate to a team that can handle it for you. Okay, so talking about processes, we talked about AP. Let's talk about AR. Similarly to AP, you want to have a client master file that will have all of your clients' data. Again, you don't give access to everyone to this file because we'll have sensitive information, but it can give you an idea of all of your customers, the contracts associated with them. If you have a CRM, you can link that contract into your CRM so that your billing person can know exactly where to find the contracts in the CRM. You can also identify in that list whether it is a subscription-based or a contract-based type of client. If you have both, you can also identify billing terms, billing cycles. It'll help you streamline your billing workflows. It will help you look really legitimate in front of your customers and increase your credibility. It will also straighten up your collections process. And what that means is that you're going to collect so much faster. And if you collect so much faster, your cash flow management is going to look so much better. We have turned things around for companies of over $10 million in revenue to really change their cash flow management when we streamlined their AR workflows, their billing cycles, and their collections workflows. And by collecting faster, they were really able to turn things around in the business. Let me just share again what a customer data file looks like at Cypher. And you can also download this and use it for yourself. It has all of the criteria that I was mentioning and more. And you can also customize it as you see fit if your customers are, have something specific that you need to take into account. So let me talk to you about some tools for AR that you can use. You can actually use tools like Maxio for billing. We love it. We are experts at Maxio. It is pretty complex. So you do need to have a dedicated billing person that handles Maxio. Your fractional finance team should be able to present you with a resource that does that for you. That's what we do at Cypher. But if you're not using Maxio, Xero is also really good with billing, QBO. There's some other good ones depending on your size, your needs, and your business model. Payroll. Listen, payroll needs to have the right tool for the size of your company. You just don't want to do an overkill payroll workflow. If you are a smaller company, there are tools like Gusto, Rippling, JustWorks, OnPay. These are really good payroll tools that your fractional finance team can help you set up. And once they're set up properly, compliant, then everything runs smooth every month. I'd say between AP, AR, and payroll, if you have these down and they're working smoothly and they're running smoothly, then you've already done most of the job and you've probably prevented tons of headaches, errors, and compliance issues. If you're a company that is a bit bigger, maybe 50 plus employees, you might want to start thinking about internal controls. At this point, operating without controls could be asking for trouble, but it's just going to increase accuracy, mitigate risks of error, fraud, and just also help you with your workflows at a much larger scale. Set up approvers, approval workflows, and put in place checks and balances, segregate duties, etc. I mean, some banks have told me horror stories about $30 million businesses, $50 million businesses with zero controls. Don't be that story. So if you've hit a certain number, a certain size, you may want to start establishing some internal controls, even if you're a private company. I mean, it's always really beneficial to have them documented and set up and put in place. So third key takeaway here, after we talked about cleaning up historical books, second takeaway was streamlining processes. Now you have a pretty good foundation, let's say. Now you want to start thinking about your monthly close and setting up a deadline for it. This is where businesses truly shift from chaos to clarity. Once you continue to keep up with this on a monthly basis, then you have a pretty good accounting and finance function. All of your accounts must be reconciled on a monthly basis. A real monthly close means you have bank reconciliations done, you have AP and AR that tie to their aging reports, you have debt accounts that tie to their loan agreements, and you have equity that ties to the cap table, and so on and so forth. I won't go into so much detail, but every single schedule should be documented. If reconciliations are not done and documented, your books are probably not done, so your financial reports are probably not reliable. There are tools that can help to keep you organized. One that I really like, and it's kind of a premium tool, it's called Flowcast. It allows you to document schedules and reconciliations for each financial statement line item within the tool, within the platform, and to set up accounting team workflows there. Your fractional team could use it. Or if you start to think about maybe having an in-house CFO and then a fractional team that supports your in-house CFO, they can also collaborate on Flowcast together. Keeper is also a good one, or you can just use a project management software like ClickUp if you want to keep it simple. ClickUp is not so simple, but you can have someone help you set it up. So unless there is a major bottleneck here on your monthly close, you should be able to issue financials by the 10th of the month. Some companies issue it by the 3rd, the 5th, but I think the 10th is a reasonable day. Once you go past the 10th, it starts to get a bit late, so you need to know where you stand by the 10th, and that would just be a recommendation and preference. Okay, so I just want to touch on one little side note here. I love working with all of our founders and CEOs. Sometimes I feel like I handpicked them because we share the same values and they're just amazing. They work on amazing things. They have an amazing vision for their businesses. But I still see them, no matter how large they are, they're in the 7 figures, but they still mix personal and business spending. Just don't do it, people, okay? Your accountant then becomes a detective. Your fractional team will start to guess, and it becomes blurry, and the taxes become messy, and the books may be inaccurate, and we have horrible audit trails, and it just defeats the purpose of everything we just set up and talked about. Investors could lose trust. If it happens accidentally, that's fine. Just label it, reimburse yourself, or tell your finance team, and they will be able to tell you exactly what to do. They will help you set up the right process to stop doing it or just fix it for you. But it's really important that it's not recurrent and that it is communicated to your finance team and that you respect the process. That way it is taken care of and not a recurring issue. Number 4, your tax advisor is not your finance department. I just did a tax forecast with one of our tax partners and we talked about this. So you may want to go check it out on one of our tax episodes, but your CPAs or tax advisor will handle compliance and tax planning and optimization. Your finance teams, they will run the business aside you. That means they are setting up your financial reporting, they're handling and managing your financial processes. And then if you also have a fractional CFO or an in-house CFO, they're also supporting him or her into giving you and providing you with the strategic guidance you need to grow the company. Tax advisors will file your taxes, they will report for you, they'll keep you compliant, that will also help you plan and get strategic from a compliance perspective. But your finance team is the one that builds your report, explains your margins, understands your business model and industry. We will model your hiring plans for you, we forecast your cash, communicate with you about your cash burn, your runway in order to plan properly. We build unique unit economics, we think about pricing, we drive decisions together. We could build board packs together. Your finance team, usually, if you are a unicorn already, you probably have it in-house. But you also can have the luxury now with so many accounting firms out there offering fractional finance team services to have a fractional finance team that acts as an extension of your company. We at Cypher will be as invested in your company. We understand the ins and outs of your company as if it were part of it, and we get just as excited about your growth as if it was ours, because we actually are almost direct, like one of the direct contributors to it. Like I said, we talk about everything that will drive your growth, especially if we take over your entire accounting and finance function, including being your fractional CFO. So completely different skill sets, and you need both. Unless you're an early stage company, and in which case it could be an overkill. But again, if you are VC backed, PE backed, and you need to have proper US GAAP financial reporting, and you need to have also forward looking projections, etc., you need to have all the skill sets to build a proper accounting and finance function than your CPA and tax advisory. And there also other experts that could come in and work in tandem with all of these, which could be a sales tax expert, R&D experts. The list goes on. It just really depends on what your needs are, and your fractional finance team is the one that can direct you to know exactly what you need and the type of experts that they need to add, so you can have all the skill sets that you need to be successful. If you're waiting until year end and just dumping a bunch of bank statements onto your tax accountant, that probably means that you're doing cash basis accounting, and that will not be sufficient for growth. Again, especially if your third parties are going to require US GAAP reporting. We will do an episode where we explain difference between cash basis and accrual basis accounting. I've gotten that question many times before. So just stay tuned for that podcast to come out or YouTube video, and you'll know exactly what I'm talking about. If you're ready to move from chaos to clarity, start with the foundation. Let's clean up the past. Let's fix everything, fix the structure, set up your processes, and everything else will become easier. Thank you so much for listening. See you in the next episode.